How should retirees use asset allocation in their conservative investments? Imagine having a plan that helps your savings last as long as you do while still earning enough to enjoy your retirement. That's where smart asset allocation comes into play. It's not just about picking investments. It's about dividing your money wisely to balance safety and growth. Retirees should start with a focus on protecting their savings first. This means putting more money into bonds and cash or cash equivalents because they offer steady income and less risk. Stocks can be included, but in smaller amounts to give some growth potential. For example, a retiree aged between 70 and 79 might have around 40% of their investments in stocks, 50% in bonds, and 10% in cash. As they get older, say over 80, they might shift to 20% stocks, 50% bonds, and 30% cash. This gradual change helps reduce exposure to market ups and downs while still keeping some room for growth. Building a bond ladder is a good idea. This means buying bonds that mature at different times, like 1-year, 3-year, and 5-year bonds. It helps create a predictable income stream and reduces the risk of having to sell bonds at a bad time. Including stocks that pay dividends can also add extra income. But it's important not to sell stocks too early because they help your savings grow and fight inflation. Reassessing your asset mix regularly is key. If your health changes or market conditions shift, you might need to adjust your investments. For example, if you find your expenses are higher than expected, you might want to increase your cash holdings to ensure you can cover your bills without selling investments at a loss. Using this approach makes budgeting easier. When a part of your portfolio is in stable, income-producing investments, you can plan your monthly expenses with confidence. You won't need to sell stocks during a market dip, which helps protect your savings. In the end, a conservative asset allocation helps you keep your savings safe and steady. It provides reliable income and some growth to address the risk of living longer than expected. This balanced strategy supports a sustainable and worry-free retirement.